Well, very excited to host this first webinar of the Climate Liabilities and Assets Initiative. My name is Thomas Annicq. I'm the co-founder of the initiative together with Mika, who will introduce herself very briefly. Maybe I'll start off with the introduction of the Climate Liabilities and Assets Initiative, and then we'll introduce you to the rest of the panelists. So climate is moving to the balance sheet as companies invest in climate transition activities and purchase an expanding set of climate-related assets. At the same time, climate costs are becoming more tangible as liabilities in the form of impacts of under and uninsured losses from severe weather, regulatory requirements, and legal liability. And when climate risk and opportunities start to show up in a company's financial accounting, it drives better internal decision-making and better informed investors. The mission of the Climate Liabilities and Assets Initiative is to accelerate, coordinate, and drive this transition, ensuring that companies and investors can account for climate-related assets and liabilities with rigor, consistency, and transparency. And to lead this effort, I'm very excited to introduce you to Mika Morse.
Thanks so much, Thomas. Thank you guys so much for taking the time this morning to join us for what's a really interesting look under the hood of a company that has been putting this into practice. I came most recently from the Securities and Exchange Commission. I was a climate policy counsel to the chair, and in that worked on the climate public company disclosure rules. And a big piece of that was where should climate show up in the financial statements? And it was a tough question. It was undeniable that climate was already having an impact financially on companies, both on the liability side and also on the asset side. But it was also clear that most companies were really far away from starting to think about this and how to account for it. And as a result, a lot of efforts on sustainability were shunted off to the side and not really integrated into the financial decision-making of the company. And while at the SEC, we were agnostic as to whether that was a good or bad thing, I think for investors, a lot of them really hungered to understand the differences between a company that had made a commitment that might be sitting in its marketing department and a company that had a sustainability plan that was fully integrated into their internal financial planning and decision making. So I was really excited to come out and link up with Thomas on this initiative because I think that an important driver of meaningful action for companies and climate sustainability is how they think about what's really at risk for them financially and what they've created value-wise in taking the steps that they've already taken towards those goals. And so then was incredibly lucky to link up with Andrew Watson, Luke Baldwin, and Paddy Linighan to learn more about what it really looks like when you put accounting into practice. So today's webinar is to really go into the details of that, of the internal business case and justification for why you would start to try, without any legal requirement or accounting requirement yet on the books, to start accounting for your climate liabilities and assets, what the mechanics are of implementing that, and then how that information can be used going forward, both internally and externally. So I'll turn it back over to Thomas to introduce our panelists and get right into the substance of it.
Right. Well, thank you, Mika. Paddy, would love for you to introduce yourself and Clyde Co.
Thanks, Thomas. Thanks, Mika. Paddy Linighan, I'm Chief Sustainability Officer at Clyde Co. It's fair to say sustainability hasn't always been my forte. I was late to sustainability, having been previously our Chief Operating Officer, but it's been a very rapid learning curve since 2020. Clyde Co are a global law firm. For those that are not aware, we have about 500 partners, around 3,000 legal professionals and about 5,500 colleagues globally, operating out of 70 offices. We believe we're unique in that we're a single global partnership, which in principle or in theory allows our clients rapid access to advice services whenever, wherever they like. Our main aim is to assist our clients in successfully navigating risk wherever they are in the world, including climate change risk and nature risk. And as an organization, we ourselves have committed to be net zero by 2038.
Great. And that theme of risk will resonate. Luke, I'd love to learn more about you.
Brilliant. Firstly, thank you so much for having me on here. I think For me, the CLAI, as we love another acronym in the sustainability world, I think it's useful to throw in, but the Climate Liabilities and Assets Initiative is crucial and critical for us to transition to a more positive, regenerative world that helps us defeat or win against climate change and nature loss. Until we recognize things as assets on balance sheet, we simply won't have the scale of action that's required and recognize the liabilities. So just thought I'd put that up.
Thank you.
I will try not to speak so much because I'm with an amazing panel of amazing people. But my name's Luke. I'm the CEO of Nature Broking. We are a carbon credit and natural capital intermediary and advisory company. We help organizations build credible carbon credit and natural capital strategies that align both to their brand, but also build reputable business cases. And so this for us is crucial for us to be able to scale, in particular, one small subsection of the asset side, as Thomas spoke about, the carbon markets.
And last but not least, Andrew, anyone who's talking about climate liabilities and assets will have at some point come across Andrew, and he's the common thread through all of these conversations. So very excited that you're here, Andrew. Maybe a little brief intro about yourself as well.
Yeah, of course. Thanks. And again, we've had a brilliant start to collaborating with Thomas and Mika in a number of calls all around the world, actually, which is proven to be really, really interesting. So I'm a lawyer by background. I was a general counsel 3 times. In 2001, I joined a startup, and all of its value was intangible. So as a lawyer, I looked at it and went, well, where's the taxonomy of what means what's reputation, what's culture, etc. That took about 17 years to sort of refine and hone in projects. I joined UI for 2 years, and when I left UI, somebody said you're going to have to solve the accounting problem. So we've spent the last 8 years doing that. I'm a dad of 5, so I understand behaviors, and discipline is very important, but we're now living in a world of upside down incentives and upside down mindset. We're rewarding doing the wrong thing. And I'm also the son of a process engineer, so I think about root cause. If there's a problem in a system, look for the root cause and try and solve it. That's what I'll talk about today. Thank you.
Mika, you want to take us through the...
Yes. Yeah. So, I mean, I think, Paddy, just to start with you, one of the things that came up a lot when I was at the SEC was just how difficult it was for companies to change the way they think about their financial accounting. And I can only imagine, that it requires some convincing internally. So I'd really love to hear from you about what the internal business case was and justification that helped set off this process.
Yeah, no problem. Thanks, Mika. It's probably fair to say our ESG journey pretty much started around the time I was getting involved, where the tactical philanthropy associated with CSR was no longer relevant. Our clients, our colleagues were looking for some much more deeper thinking, particularly around the ESG. And our strategic approach to operating responsible businesses effectively then morphed being delivered in 3 pillars through diversity, equity, inclusion, well-being, pro bono, social impact, and more relevant for this discussion, environmental sustainability and biodiversity. In 2020, 2021, we started an exercise to understand where we were positioned in the marketplace, what was being asked of us. We were starting to see clients setting carbon reduction ambitions, net zero targets, etc. And so we had a level of ambition then, which I would call probably market leading equivalent, if I can put it that way, whereby we knew as part of the supply chain for our clients that we had to, in effect, help them meet their targets. And the usual discussions internally was sort of that back and forth about what does it cost to set up a team, what's the cost of reporting, what's the cost of compliance, so that what is the cost of action, what's the real benefit here. But we had a game changer in March 2022, whereby one of our clients, alongside another, but specifically one, set short-term decarbonisation targets on us as part of our supply chain contract. And what that did was rather bring this slightly nebulous 30-year window of 2020 to 2050 into sharp focus into 3 years. And what that meant in discussion terms is, instead of me being able to talk around the cost of a sustainability team or a cost of a sustainability system, I can actually talk about the cost of inaction as opposed to the cost of action. And at that particular point in time, that cost of inaction was into multiple millions. And it got the board's attention. And I unashamedly lent into the extrinsic values of the board on that discussion. Whether you agree with the science or otherwise, it's no longer a moral imperative. It's just become a business imperative. If we fail to do this, we will lose revenue. But there are other aspects to it. As we start to see the generational pieces coming through, we start to see greater demand for what we were doing in relation to sustainability in a wider sense from our colleagues, from talent that was coming to the firm, particularly early careers. I heard a phrase last week described as zillennials. It's that crossover between Generation and millennials. And it just became such a requirement from a business perspective that it just then became a non-discussion. The cost of inaction was far outweighing the cost of action. And if we roll forward now, and I think we talked about this as we're sort of setting up the discussion, even if I just look at our top 25 clients, I know 19 of them have got some form of carbon reduction plan. 17 of them have got net zero targets, either associated with science or direct with the SBTI. I'm sure there are more in our client base. And so I know as a minimum, from the point of view when we go to talk to the board, that at least a third of our revenues globally are tied into those clients. It just becomes a non-discussion. The business imperative for us is clear.
Wow.
And so that's a great kind of segue then into what happened next. So, after you've made this business case, how do you go about thinking about the next step? And then, and maybe that sort of brings in Andrew and Luke a bit to talk about the accounting piece of it. But Paddy, maybe transition us into, you've got the business case, now what? Because there are lots of potential options I can imagine for action internally.
Yeah, very much so. I mean, the one thing that being in the professional services sector, and particularly being in the legal services sector, when you hear about all the conversations about greenwashing, green hushing, etc., given that we had a climate risk advisory practice, the one thing that we had to be was authentic. We had to be able to articulate what it is we were doing in a true sense, as well as match it with action. So it wasn't just setting this high ambition of net zero by 2038. We had to make sure we had an effective roadmap to get us there. So we were working at the time with an organization called Carbon Intelligence, they're now an Accenture company, to help us develop those time-based phased roadmaps in order to genuinely deliver on our net zero targets. Oh, bless you. And it was one of those sort of programs that started working with, and we recognized as we started to get the decarbonisation programs running, that we had this obligation, we had this commitment that we've made externally, which is we will be net zero by 2038. And with the best will in the world, I think any organization that started this journey recognizes that it's impossible to decarbonize your operations in its entirety. There will always be residual emissions at the end of this. And that's when the conversation with Luke started and Nature Broken is, how do we go about solving a problem now which meets a commitment in 14, 15 years time? And that was really sort of the start of the carbon offset discussion. But in the meantime, started to talk through with Andrew and others around sort of the accounting for effectively taking net climate action. And whilst I talk about it being a business imperative and that cost of revenue, the revenue being a cost of inaction versus cost of action, nevertheless, there is still arguably that disincentive that we've faced, is that as we've gone on this journey so far, all of our costs of taking action to respond to that net climate change is being expensed. It's being expensed to our P&L. And so we started to explore, well, how could we look at both recognizing the external commitment that we've made, the expense that we've incurred in trying to meet that commitment in a way that would recognize the benefit that we were trying to achieve. So that's when the conversation with Andrew particularly started around IAS 37, and then with Luke around IAS 38, in relation to what it is we want to do, both on our journey to get to net zero, but also on what does it look like in building the asset portfolio up that enables us to claim net zero from 2038 onwards.
Great. Thank you so much. So, Andrew, turning to you, I think on sort of this broad framework of what is IAS 37 and how, did you all start helping Clyde Co put that into practice?
And how did you, because IAS 37, Andrew had quite a
That's right.
role
That's right.
in the clarification there too, right, Andrew?
It's a good story, and if I bang on too much, make sure you stop me. So just for a couple of minutes, really, to sort of give a bit of context for all of this. So back in 2020, we were doing a BP case study. You might remember BP had made some concrete commitments in scopes 1 and scopes 2. There are about 11.9 million tons of CO2, and some scope 3 commitments to reduce carbon intensity by about 5%. That's about 35 million tons. So they're big numbers. But the thing we realized is that BP had actually done pretty concrete plans how we could get there. These weren't vague, finger in the air. This was short-term transition plan, etc. And we looked at that. We wrote a paper called Constrained by Accounting. And what Constrained by Accounting said was the incentives to meet, the accounting incentives to meet those commitments are the wrong way around. So the commitments were not being recognized as accounting obligations. And as a result, the investments weren't being recognized as assets. Now, remember, I'm a lawyer rather than an accountant. We described that as a root cause of the inability to tackle the climate biodiversity crisis. We described the mindset effect of essentially what you've got is upside down beliefs driving upside down decisions. And so I pulled together an amazing group of technical accountants from around the world. It is literally like the Rolling Stones. And said, how do we do this? How do we flip them? But how do we flip them going right back to basics and using existing standards? And that's what we created in what's now called Accounting for Reality. All it is basically recognizing intangible assets and obligations that exist in reality, but which accounting isn't recognizing. Using existing standards, 37, 38, and this being used for forward-looking decision-making. Paddy, this really plays into where you're trying to get to. Forward-looking decision-making using a supplemental TCFD non-GAAP information. I won't go into pilots because I think it's probably not the place to do it, but let's just talk about IAS 37, which as a lawyer, it's really easy to read. It's just super logical. Principles-based standard, it basically says if you have a liability, then you have to categorize it. Is it probable, more than 50%? Is it possible, less than 50? Or is it remote? And if it's probable, you recognize a quantified accounting entry. If it's possible, you make a note and you quantify where you can do. So having seen that, we thought that an emissions reduction commitment with a transition plan met the definition of a constructive obligation right in the middle of IAS 37. And so when you don't know what the rules are, you go and just follow common sense. So we took that decision to a group called the Interpretations Committee of the IASB. And what became a rather bitter fight over 8 months finally gave us a decision that you could recognize your commitments and transition plans as constructive obligations, and therefore you could then recognize your investments as assets from which future benefits flow. This is literally just using 37, 38. Anybody who wants a further explanation, I can bang on for days about it all. But when you play in where Paddy's trying to get to now, Paddy's saying, well, as a business case, how do we then create that forward-looking decision-making framework for the board to say, all right, we did say 2038, and we model earlier. We did say this amount next year. Well, if that's all going to assets and the stick of the commitment itself is relatively small, which it will be in most cases, what can we do? What can we accelerate? How do we show ourselves as pioneers and leaders? So that's the context of which I began to talk to Paddy, Paddy now lives an hour north of me, and we're just trying to work out actually where in the northeast of England. And Paddy and I are now trying to work out with Luke, where do we go from here in terms of real concrete thinking about what can we do going forward using this framework.
So before we get into maybe a few more details about exactly how this applies, some of the actions that Clyde Co has taken, Luke, can you take a moment to sort of bring in a little bit more detail on IAS 38 and the treatment of carbon credits as intangible assets?
Sure. So I think just to I mean, I think there's quite a few people in the room who come from sustainability teams who've got experience here. And how many times have we as individuals heard the word, oh, but this is a cost center, or this is expensive, this is affecting profitability. And for me, I think one of the key things here is just to sort of to discuss the narrative here, which is, oh, well, if this is a cost center, it's affecting profitability. Ultimately, oh, well, we won't do it, or times are bad, we'll lower our sustainability budget. And I think this is what is really key here. This is not something, and why I'm such a sort of cheerleader from the sidelines in the, as Thomas said, with Andrew, the kind of the great and the good, is this element that we're looking at this in the wrong way, which is, if you can put it on a balance sheet, it gets taken out of profitability. It no longer affects executives' bonuses. It no longer affects, your stocks to share ratio, your equities ratio, all of the financial metrics that are used by businesses to calculate, or analysts, but to calculate what your business is doing. So when times are good, fine, we can put some money into it. When times are bad, it's got to go. And so ultimately, I think changing that narrative and starting to look at ways in which you can create real tangible asset value is really important. So the way in which we look at, so Andrew has spoken about IAS 37 around liabilities. What we look at is the asset side. So if you've made a commitment and it is likely, in the UK's context, it is more than probable or not. I'll leave you all to kind of define what that means. But ultimately, if it is more than probable or not that this is going to lead to capital outlay in the future, then ultimately you should being the operative word here, again, as always, we like to leave it grey. You should recognise this as a liability, and therefore that anything that you do that sits above the line can be seen as asset. In real world, or in the world outside of climate, this is the case with mining, for example. You have a policy to rejuvenate a mine. It's a physical asset. Ultimately, you have to squirrel away a proportion of the funds that is going to require to rejuvenate that mine, and you're going to put that into a little pot away. And then ultimately, when it comes to the end of your mine's life, you then use that funds to draw down, and it balances out. Now, ultimately, we can apply this to net zero. So this is exactly the same, where I have a liability. I need to decarbonize by a certain amount per year, which has a certain cost. Therefore, that cost sits as a liability, and anything that I do above the line can be created as an intangible asset. Now, an intangible asset in the UK is defined as a whole host of different things, but is defined predominantly as having trust, having ownership, having a finite life. And so therefore, we believe fully that a carbon credit in its such is an intangible asset. And this is backed up now by different forms of accounting and the work that we're doing with Clyde Co. And as it is an asset, ultimately it can be accounted for as an asset on a balance sheet. Now, there's two ways that you can do that. You can either account for it as inventory. So if it's going to be utilized, you can account for that as inventory. So you take it at cost. It doesn't accrue value, but ultimately it has value. Or you can then, at some point in the future, we think we'll be able to market rate, which is when you can then account for it without a liability. And that's when you get to really exciting things, where the intrinsic value of the carbon credit or the climate action you're taking is then held as an asset, rather than having a sort of requisite liability that sits on the other side. So the long story short is, how can we take what is cash-rich businesses and profit, so P&L poor, and how can we start to allow them to have action in a way that really creates value for an entity? And I think that's what's really exciting about this.
We will be doing question answer, but I just wanted, there's a question in the chat that is sort of relevant to just what you're talking about right this second, Luke, so maybe you could address it before we move on. Is just, the question is from Jake, and it's how can a reduction credit represent an intangible asset? Emission reduction credits are based on counterfactuals and don't create a lasting asset, only an avoided scenario, and some insight on that would be useful.
So I think this is really clear in terms of how you look at this. So how do you look at what you're doing? So if you've made a commitment to reduce your emissions, that is the liability, and therefore anything that you do that sits above the line is the asset. So ultimately, if you say you're committed, for example, if you have a policy that says I am going to restore and I plan on restoring 10,000 hectares of land for the next 10 years, that is a liability that can be accounted as long as you go ahead and do that, as long as it's more than probable or not that will lead to a financial outcome or that you will need to pay something for that. You should be, again, I come back to the should and probable bit, accounting for that as a liability, and therefore anything that you do that sits above the line. In this case, it then depends what you're doing with the reduction. And I think Andrew, will probably jump in here and provide me with it. If you hold it, ultimately it has intrinsic value because it can then be utilized because you're drawing it down as inventory, or once you retire it, you would then write off that reduction. So at that point, you would write off and you get your balance. But I'm actually going to fling this over to Andrew because he, in this sense, he's got case studies that I know he's working on.
Well, Thomas and I actually wrote a supplemental submission to the Interpretation Committee on IS 38 and started to draw some of these themes out. I as ever, when I go into a new market like this, I actually have never heard the expression used that was just used. But if I take it back to its common sense, the common sense is once you've recognized an obligation, then any activity that you're actually undertaking to meet that commitment should be recognized as an asset, pound for pound. So, for example, in Paddy's case, we talked about a team was set up to mitigate the risk of this. Therefore, that team should be recognized as an asset, not a cost, which is quite a big statement of what is the reality, Paddy. So I'm sorry, I don't know the concrete answer to the question. All I know is that, as we said with carbon credits, or anything which represents an investment into an activity which is purposed to meet the commitment, that can be capitalized and held on your balance sheet. What Thomas and I tried to imagine was then, if you can catalyze this market, you actually are essentially creating a market for averted emissions in which there will be instruments which represent that. And that's therefore the theory of anything that you're investing into should actually be held as inventory because that market is going to grow. I think, Paddy, you might want to jump in because I think that's your way of thinking about this right now.
Oh, thank you, Andrew. Very much so. And I think when we look at IS 38 and Luke's interpretation there of when it's inventory versus when it's then continued to be revalued at market value, I think that the wording that sits in there at the moment is if you are acquiring the removal offsets for your own purposes to meet your own obligations, that's the definition of inventory. That's when you carry it forward. So our interpretation would be, for example, we might buy 10,000 tons of CO2 removal credits this year, which don't then mature, etc., until 2038. They will be held on the balance sheet until the point of retirement. And then at the point of retirement, we've used them. Therefore, that's when that cost flows through to the P&L. Now, the benefit of doing that now, when you look forward in relation to pricing curves, when you look forward into demand pinch points, is that by investing now, we see it from a Clyde Co perspective, is we get the opportunity to fix price and we get an opportunity to fix supply. What it also does is it allows funding to go into the offset market to essentially expand the market as well. So we see it twofold. One, it's allowing us to meet our obligation right up front. As Luke has gone into, the P&L effect in the short term is mitigated by the fact we're carrying it as intangible. Ultimately, by the time we come to need to use it when it has a P&L effect, it's at a much lower cost than it would do had we buy it at spot in 2038 to retire at spot. But at the same time, we provided liquidity and funding to the carbon market. So from that perspective, we see it's a win-win for us to a degree.
And then there's an even slightly added benefit that you're bringing the climate intervention forward in time, right? And every time we do that, that has actually a huge compounding effect. Right?
I think
we can. Oh, go ahead, Luke. Were you?
I was just going to say, I think coming back to the business case as well. If you like, if we look at the carbon markets, we have to perpetually ask ourselves why. Why should I as a business write this, buy this? What is the underlying business case? And I think it's really crucial to start looking at this in terms of, essentially hedging. The core facet that we've got is that if we take the work that we're doing with Paddy, is that Paddy has a commitment. He's going to deliver on that commitment. That commitment can be capitalized as a liability. But he also has, I look at the forward projections, what the price per ton is going to be. And therefore, your business case is not just I'm creating an asset value and pushing, as I say, as Paddy said, the costs through to the P&L by 10 to 15 years. It's actually looking at it and saying, well, I'm hedging against future price risk. And I think this is a really important thing that we need to be getting into the market. It is, impact, but couched in a really tangible business case, because it's not affecting profitability. You are hedging against future price risk, and ultimately you can then set serious cost savings from that. So I think this is where it gets quite interesting, and where we as an industry, from the carbon markets point of view, are starting to grow up to, which is, it's how do we create something that has tangible value for the organizations that we're working with, that can then be utilized and presented in a way that you can get through in a 2-minute board segment. Because as always with sustainability and this, going to board is the thing that is the major challenge. I call it the sustainability valley of death. It's all let's do it, and then you go to board and it goes, oh, maybe we'll do it next year. And so if we can solve that problem, if we can solve the board and the business case for doing this, suddenly every business is run by people. People want to do something that is good, because ultimately there is a generational thing here, which is, I'd quite like to leave the world in a better place. And I think everyone does to a certain degree. And so giving them that opportunity, working within the financial boundaries that we have at the moment, not looking for systemic change, working within something that is as simple as an accounting principle, is hugely beneficial and very exciting coming forward. And I think this is why I get quite giddy about this and very passionate.
I'd like to get a bit even more into the details, because I think it's so interesting to think about how you operationalize this. And so, I'd love to hear a little bit about, how do you think about valuing what goes on the liability side? And then how do you think about valuing what goes on the asset side? And what does that process look like? And Andrew or Paddy, whoever wants to take it.
Paddy, shall I give it a go first?
And I'll follow in.
So I think maybe the most powerful thing we're doing right now is actually to demonstrate this this is a real company. I can't tell you who it is, but this is the way the methodology works in 3 steps, so 3 accounting entries. So this real company made a couple of commitments back in 2020, which it will have met by the end of 2025. It was a scope 1 and 2 carbon neutrality, and a scope 3 in its operations. Aggregate of the two was about 1.2 million tons of CO2 to meet those. It will meet them by 2025. It's scope 1, scope 2 was accelerated. So let's jump. I talk about slalom to the bottom right of the balance sheet, and we first of all have to construct an obligation. This is IAS 37. We know it's 1.2. We know it's not a one-off hit. It's actually over time in a series of steps, and now with a transition plan. IAS 37 requires the use of estimates. It requires the use of estimates. It says there's only exceptional cases where you can't use an estimate. This is what accounting is all about when you're looking forward. So this company has a shadow carbon price that it already uses. Of course, that has a set of assumptions about imposition of externalities over time of $105 per ton. I know that's towards the top end, but that's what they use already. So 1.2 times 105 gets you to, over time, about 125 million. As an obligation over time, which is material, but manageable. Entry 2, the company spent about 240 million to meet that obligation in 4 activities. 1 was a switch to renewables, 2 was retrofitting its production facilities, 3 was nature-based investments, both intact and high integrity credits, and the 4th was its team. And across all of those 4 activities, we can then identify that cost at cost, and we capitalize that. Therefore, you can see the profitability has gone up by the amount over 5 years. And then we ask the question, what are the future economic benefits that flow? This is the 3rd set of entries. And you can see that the avoidance of future imposition of externalities is clearly a benefit. And also there's a paper we've got from Standard & Poor's that said this will improve credit rating analysis because I can see certainty of future cash flows. So you quickly get into a fairly simple analysis of the mitigation of an obligation of 125 over time, capitalization of activity at cost, economic benefits, literally is the flip of the shadow carbon price. Again, an estimate, as IAS 38 requires. And so you get to an amount with this one where we sort of estimating that the benefits would be around about 800 million for that 1.2, which sort of logically makes sense depending on which shadow carbon price, which social cost of carbon you use. So it is, as you know, a fairly simple three-flow methodology to be used in forward-looking decision. Paddy, you might want to jump in and give a
Yeah. Well, in fairness, that three-step process is obviously something we're starting to look at now. We're clearly different to the organisation you're referring to there, but we certainly made our external obligation, our commitment to 2038. We know how much tonnage we're committed to reduce, partly on the journey between 2030, then on the journey from 20 to 2038, which gives us a liability assessment. And as Andrew quite rightly points out there are a whole series of costs associated with how we meet that, the team. We're not necessarily at this particular point in time looking at nature-based solutions as part of that journey, but we might do. But it's around how do we then start to decarbonize our scope 1, scope 2, renewables, etc. From that point of view. For our scope 3 for a professional services firm, business travel is key for us in terms of what we need to look at and the cost of being able to reduce the impact of business travel. And then perhaps more challenging is our own supply chain, our own purchase goods and services. So what are the costs of engaging with that supply chain? What are the costs of switching suppliers from from unsustainable to sustainable suppliers? What does that do to our cost base? So all of those sort of costings come into this. And then to that third point, which is something I think I describe as a work in progress with Andrew, and that's more our case rather than Andrew's, is what are the economic benefits? What's the benefit for doing this? And that's before we've even got into the discussion of how we account for carbon credits. So there are sort of two lines of thought going here. One is the action we're taking against the commitment, and then it's almost as it's how do we fulfill that final obligation piece, knowing that we can only decarbonize to a certain degree. And that's before we've even looked at the new SBTi corporate standard, where it might bring some of the offsetting forward, etc. But at the moment, it is around meeting that ultimate obligation of 2038, but investing now and planning now so that organizationally we meet that. Failure to meet it is reputational damage for us.
And
it's significant.
Just talk on, because whenever you talk to someone about this and you mention the idea of turning your net zero commitment into an obligation, the reaction very quickly is, but isn't that going to slow down these commitments, right? And so can you talk a little bit about, because you must have had that friction inside Clyde Co as well. Can you talk a little bit about that dynamic or those, how you overcame that, right?
Well, it's a good question, Thomas. I think it's probably fair to say, because of the extent, you could say, of our exposure, revenue-wise, etc., that on one level, whilst it sounds a bit, on one level, we were prepared to take the cost of action as a cost of doing business. And that, I suspect, is being primary, also certainly in some cases, primarily the reason others haven't, because it's just an additional cost to the organization. But when we pivoted from that cost of action versus cost of inaction, that friction to a degree disappears because it's so vastly different. But what we've been doing over the conversation of the passage of time and exploring how we effectively account for these, we've actually picked up, and I think this is coming up through some of the chat comments on some of the questions, these things have been around for some time. But because nobody's thought of them in the context of carbon reductions or carbon offsets, that it's never really been thought into that context. So the conversation Andrew was having earlier about thinking about how do we actually start to challenge this and stretching the interpretation and then getting that accepted, you start to think, actually, even though we started this journey in 2020, 2021, I could have been putting them on the balance sheet. I could have added even less friction in the conversation than I had at the time. And maybe it's the cost of action. I might have been able to do with the cost of action and not have to wait for such a significant cost of inaction, because the options for us to deal with it were already there. Yeah. I would say we, as a sort of trying to drive this, were fortunate in one regard, or unfortunate in other, depends which way you view it, that such a significant risk on our revenue profile, both protection and generation, made that debate almost, well, it might be a nicer way of being able to do it, but actually we'll just take this as a hit, because if we don't, the hit's so much bigger.
So,
I just sorry, Mika, I just want to acknowledge the questions that Genevieve has put in. Genevieve is creating a few waves on LinkedIn right now. I'm ever excited she's on, and actually she's raised some great questions, but I think we'll come back to those when you're ready.
Yeah, no, thank you. We are checking these questions, and we're going to be sure to save some time. So to make sure we do have some time to get through some of these questions, Paddy, I think you've done a great job of talking about the value of this for internal decision making. But I know also too from previous conversations we had, this is not just relevant internally. This has had some real impact externally as well. I know that you had sort of talked about how this affects, financing costs, and so I wonder if you might talk a little bit about how this accounting information is used by external stakeholders.
Yeah, I mean, I'm conscious as we were talking through the sorts of costs that we may be avoiding or indeed incurring as we work our through to our net zero journey. But yes, we took the opportunity, and again, coming back to that authenticity point, we took the opportunity to be able to tap into sustainability-linked credit facilities. 2 years ago, with one of our providers, we sort of put a toe in the water, linking our emissions reductions targets, certainly around scope 1 and scope 2, which we kept together, and then scope 3, that in meeting those targets, that would reduce our interest burden. And it was such that there is another target which is around diversity and inclusion, but those 3 KPIs together, meeting those will allow us to benefit from lesser interest costs. It was successful in year 1, and therefore as a consequence, last year we converted the remaining elements of our club facility into sustainability-linked credit facilities, but on the same KPIs. We didn't create any new KPIs for those SLCFs. Those were aligned to our strategy, aligned to our objectives, and those were comfortable with all of the banks in how we adopted them. So it wasn't about creating something new. It was something about our funding, our credit risk, our interest rates were all aligned to what we were trying to achieve strategically. And that's proven to be, at the time, I think certainly the first one was unique in the legal services. I don't think it was unique professional services, because I think EY might have beaten us to us at the back end of the previous year. But it focuses the mind, because it's not just around what it is we're trying to achieve on net zero. It actually has, as well as sort of the intangible attraction retention piece, there's a real tangible piece there, in that we're effectively putting our skin in the game in terms of the way we work on it. And it's, I think from a banking perspective, whilst they wouldn't necessarily come out and say this overtly, I think it also helps their proportion of green funding and sustainable funding that they're providing, even if it is sort of slightly disconnected or indirect, not disconnected.
Nice, I like that, Paddy.
There was a bit of research done by MSCI which tracked essentially, I mean, it was sort of at the top level, it was ESG, more ESG friendly businesses, and by and large they received a 0.5% reduction over the course of, I think, of a year. They've managed all of this. I can share some of the reports afterwards, but a 0.5% reduction in their debt costs. So if you are more ESG friendly, you do have cheaper access to debt. Now, while 0.5 seems, minimal, but actually over the course of, say, 100 million or 100 billion, that's that's quite a lot of money. That's 50 million. Got my maths model. Over 100 million, it's 500 grand, which can help pay for the sustainability initiatives that you're doing. So, and again, it's about, I think, this professionalization of sustainability as a whole and looking at through accounting lenses. Could 500,000 be used to reduce your emissions by a significant chunk on an annual basis? For sure. And so I think it's a really powerful tool, debt, I think, and what access to debt can do, because ultimately, I think it was slightly off topic, but I think it was JP Morgan who came out last year that said that ultimately, whether you call it climate risk or not, it's just risk, and we are more exposed to risk, and therefore we need to lower our climate impacts because climate has effect on our portfolio. If we take, I think it was the S&P paper that Andrew spoke about there, which is said, if you've got assets that ultimately are being depreciated or amortized over, say, a 10-year period, and that asset suddenly becomes flooded and goes out of service in a 8-year period, you've got 2 years worth of impairment that you have to put onto your P&L. There is a straight financial hit that you're going to take. So whether we like it or not, climate is coming on the balance sheet. It will either come in the form of essentially hits on your P&L in the future because you didn't account for it correctly, or it will come in the form of getting ahead of it, as Clyde are doing and others, where you can actually account for it correctly, and then you don't have to take that impairment.
Yeah.
Just thought I'd add that in.
Thank you. So one of the questions that I did want to be sure to address was around the implications of the new standard by the U.S. Accounting Standards Board, FASB. And, FASB, as many of you may know, had put out a proposal, received comment, and then voted as a board to finalize a standard, which will now be written going into 2026, around how U.S. companies should be accounting for carbon credits and offsets and other environmental credits. And it basically set up sort of a two-prong approach, where if you have environmental credits used for a compliance purpose or with the intent to sell, then you can record them as an asset. But if you are purchasing an environmental credit for your own use to meet some kind of voluntary commitment, then it must be expensed upon purchase. And that included even deposits on forward purchases in sort of offtake type agreements. And the issue there is that you have to make this decision, it seems, at the moment that you're acquiring the credit. And while in the US context, that might sort of be a fair reflection of the primary use of credits at the moment. You've got compliance credits, people who want to potentially trade them, and people who are using them for their own internal use. It really seems to go against the structure that you guys have described here, which involves the idea of purchasing a number of credits at lower prices today, holding them, and then you can apply them or sell them, but you can make that decision later and have that expense flow through the P&L later, and have that, help for the internal planning around that, meeting those commitments. And so I'm curious a little bit about your thoughts about how much that change in standard in the US could affect the way that companies think about doing this sort of accounting.
I'll jump in, Mika. So after the IS-37 decision, I was introduced to the Emerging Issues Task Force at FASB, who had been asked that question as to how carbon credits could be recognized by big companies that were buying a lot of carbon credits. And interestingly, the initial findings of the EIT were, well, why did you buy them? Because if you bought them to meet a commitment you've not recognized as a commitment, you can't then recognize them as assets, because it's about the purpose of why you bought them. And actually, logically, that's exactly how it should work. A voluntary commitment actually is not a commitment. It's not recognized as an obligation. The view we eventually concluded after actually a few meetings was actually you got to step back and think about how do you get equivalence to IS-37, IS-38 in a US context. And actually the right way we thought about it and discussed with them privately was as asset decommissioning. So it's exactly what Luke was saying before. So you get to the end of a license period, and then you have the obligation to reinstate. And actually that's an entirely different route through 2 or 3 other standards. But ultimately it says, what's the purpose for which you bought them? or investor generally, if you've done it because you made a commitment that you recognize an obligation, then you're doing it actually for that purpose. If, however, you're actually just recording the asset because you bought it because you decided you want to buy it, I can see exactly why actually that conclusion was reached by FASB. It's not as complex as people are making it out to be.
Yeah, and I think it's an interpretation of what's happening today, right? I think FASB is not in the business of writing prescriptive rules, but they're more descriptive of what's happening. And I think what's exciting about the example that we're bringing here to you with Paddy and Luke and Andrew is that this is not the only way, right? Buying these credits and retiring them and is there is another pathway that just gets you into better decision making all around, right? From consistency around your commitments to consistency around what you're saying you're doing, right? And so I think this is just very compelling, and that's why we're so excited to share this with you, and so that others can follow and join, right? I think that's the hope. Yeah, I think Genevieve has been quite active with her questions, and in a way we all share your frustrations, Genevieve. It is it's mind-blowing that this is not happening yet, and it isn't happening yet because we don't have policy makers providing clear guidance yet, and it is because investors haven't really been very vocal about asking for it yet, and companies as a result are not really doing this yet either. But we see a seismic shift here changing. Policymakers are talking about it and figuring out how to do this. Investors are trying to figure out how to ask and how to get access to better information. And companies like Clyde Co are innovating, right? And showing how it can be done. It leads to better financial results. It leads to more transparent communication to all your stakeholders, whether they're your investors, your customers, or your employees. And this is just realigning the incentives, right?
I think
so.
The most the thing that gets me really excited is that this is really the first step. Ultimately we're having to recognize liabilities, which is important on this journey. But from my point of view, you don't recognize a liability if you buy a share of Apple, or if you buy a share of, you're not saying, oh, I'm going to buy a share of Apple and therefore I need to recognize a liability that is they might go bust tomorrow, for example. You don't do that. You just take the price and you market to the price that is seen within traded markets, and so on and so forth. And I think that's really where we want the goal to be. Is you want that to be a tradable good at some point in the future where there's no liability associated with it, because we know that from, again, coming back to the point about businesses are made up of people and people want to do things. And I think what's really exciting is that we think that natural capital assets or carbon credits as a whole is a start in that, something that is probably, it's a massive private asset class which could lead to huge growth. And therefore what we want to be doing is turning the guns of capitalism into this. We want to be looking at the insurance companies that have huge pots of investment cash, who are committed to climate liabilities, who are saying, who are committed to climate action, who are saying we need to lower climate action because it directly affects us. The more climate problems we have, the more risks we have to our business, because ultimately we're an insurance company and we can't insure things in Florida, for example, because we know we're going to get hit by a massive storm every single year. So how do we then allow them to do and invest in things that help mitigate the climate, but done in a way that allows them to actually, for it to be a tradable good that creates value? And I think that's where it gets really exciting, because then you're no longer thinking about this in terms of risk, liabilities, etc. You're just thinking about value. And until we can take, to use the sort of slightly cheesy saying, until we can internalize the externalities of our impact on society and on the climate, we will be fighting a losing battle, in my opinion.
And also just to respond somewhat to Genevieve's points about materiality and misleading statements and securities fraud, I think that the more that sustainability is integrated into internal financial planning and then externally presented in financial disclosures, I think we all get a lot more clarity around what companies are really saying with their commitments and what they're doing about them. And from an investor perspective, that is very important for thinking about how to allocate capital to the companies that are preparing themselves to be thriving and profitable against a changing climate and economic backdrop. And it is also would be important for regulators, I think, to really then be able to push past what is maybe, confused under marketing and sort of aspirational statements to figure out what really are the material statements that are being made and how can companies be held accountable for them. I think in the US, we're a bit of a ways off from that. The public company climate disclosure rules that would have gone into effect if we'd had a different administration implementing them, I think would have gone a long way to bringing some of that rigor. Now, those are being challenged in court, and I think, it'll be a bit before we have, political impetus again to really work on that at the federal level. But I think what we'll see coming out of California in particular is going to move that ball quite a bit forward. And companies will now, to Paddy's point, in thinking about what's the cost of inaction, they will now, sort of be put in the public spotlight for what they have committed to, but then maybe the shortcomings of what they are or are not doing about those commitments.
I think. Sorry, Andrew, you go.
No, I think we're at time, aren't we? I wasn't trying to. I could go till midnight, but actually tomorrow. But I was only going to say, Genevieve, I'd love to continue this conversation. I share your exasperation and the barriers. I think they're coming down. I think they're coming down particularly because there's a business opportunity here.
I think just to add on to that as well, we as a group, what we should be doing is lobbying the VCMI, the SBTi, the ISO, these standards, because ultimately they are the ones that should be setting this from a corporate point of view. They should be saying, if you're going to be entering into these programs, you should be accounting for this as a liability. If we were to be able to, the SBTi stated to everyone, you must account for this as a liability, what your spend is going to be. Perhaps there would be a lowering of action, as Mika mentioned and Thomas mentioned, but it would also hold people more accountable. And then, as we've just been talking about, it's where investors can come in and say, well, if you're going to make this commitment, we expect you to make this commitment and recognize it so that we can read it on an annual basis in your company accounts. Yeah, and that's where it goes.
No, and I think the lowering of maybe the SBTi commitments would come from those that aren't in the business of meeting them anyway, right? And so they're not valuable, and we might as well. But anyway, I think we are, this is the first of many to come. You can, I think, reach all of us through LinkedIn if you had further follow-up questions, and we're looking forward to what's next.
Thank you all so much.
Thanks all.
Thanks, Thomas. Thanks, everybody.
Thank you.
Thanks, Thomas. Thanks, Mika.
Bye.
Cheers. Bye.